The economy is built on arbitrage, and AI is blowing it up. So let me start with something that sounds old, well, because it is. For thousands of years, the economy is run on one simple idea. Buy something where it's cheap, sell it where it's expensive. Buy low, sell high, right? We all know that. That's it. That's the whole game. Merchants along the Silk Road knew it. Shipping companies know it. Wall Street knows it. The gap between cost and price. That's called arbitrage. And it's the invisible engine underneath basically everything. Did you know that AI is destroying arbitrage windows that took decades to build, and it's doing it in months? And then when those windows close, new ones open immediately, but somewhere else and often owned by someone else. So that cycle, arbitrage collapsing and reforming, is the most important thing happening in the economy right now. It's underneath the labor conversation. It's underneath the tech conversation. It is the conversation. So let's have it. First, what's arbitrage? Arbitrage isn't about somebody being shady or someone being ripped off. It's just a gap. The law firm that bills you 10 hours for work that takes 2 hours of thinking and 8 hours of research, it's not a scam, it's a business model built on the historical cost and difficulty of legal research. The offshore development team, well, they exist because an engineer in San Francisco costs 4 times what an engineer in Bangalore costs. These gaps are the structure of the market. Entire careers and industries exist because some of inefficiency was too expensive or too invisible to close. Until now. So in late 2025, a single trading bot on a prediction market called Polymarket turned $313 into $414,000 in 1 month. 98% win rate over 6,600 trades. It didn't predict anything. It didn't have insider information. It just noticed one thing. Polymarket's short-duration crypto contracts updated their prices slower than the actual crypto exchanges. So when Bitcoin moved sharply on Binance, sharply enough to make the outcome of a 15-minute contract basically a sure thing, Polymarket was still showing 50-50 odds. The bot bought the missed price side over and over while humans slept. A developer later claimed to have reversed engineered the entire strategy and rebuilt it in Rust using Claude in about 40 minutes. One person, a laptop, and an API key. Work that used to require a quant research team, software engineers, and risk managers. And it's not a one-off. A separate AI system generated 2.2 million in 2 months reading news and social data to interpret public information faster than the crowd. A sports betting swarm model pulled 1.49 million trading NBA contracts, not because the strategy was better than what humans were doing, but because the execution was flawless. No fatigue at 3 a.m., no oversized bets on a gut feeling, no missed trades during the kid's early release day. What makes Polymarket so useful as an example is that the data's public. The trades are on the blockchain. You can literally watch the arbitrage window shrink. In 2024, that window lasted about 12.3 seconds. By early 2026, they were down to 2.7 seconds. You can see the inefficiency closing in real time. That same mechanism is at work in every industry. You just can't measure it as cleanly because most industries don't publish their lags. But once you have this lens, what inefficiency is this built on? You start seeing it everywhere. Here's a taxonomy of the gaps that are closing the fastest. Speed gaps. One system updates slower than reality. Your competitor's pricing model runs in real time. Yours updates weekly. Their support bot, it resolves issues in seconds. Your team takes 24 hours. Their hiring pipeline screens candidates in minutes, while yours takes 3 weeks. Every one of those is a speed gap, and each one is now closable by whoever builds the better, faster system first. Reasoning gaps. This one's a little bit more subtle. The information's public, available to everyone at the same moment. The gap is how fast someone can figure out what it means and act on it. A press release drops. An earnings call reveals a strategic shift. An LLM can read the full context and update its model of the world in seconds without getting distracted or going to lunch. The analyst, who just needs to sit down with it for a little bit. They're burning time that used to be tolerated, but now isn't. Fragmentation gaps. It's the same thing priced differently in different places because nobody's looking at all the places at once. Sports arbitrage. Bots scan multiple books and lock in margins by buying both sides when the combined pricing implies an edge. The business equivalent is the consultant, who charges significant fees to synthesize 5 publicly available data sources. The value is never in the data, it was in the aggregation. LLMs aggregate for free. If a deep research report is outperforming your agency deliverable, You're already feeling this. So discipline gaps. The inefficiency isn't in the market or in the information. It's in the human executing on the information. Polymarket data showed bots using the identical strategy as human traders, capturing roughly twice the profit. Not a better strategy, just perfect sizing, no emotional overrides, no inconsistency. That discipline gap exists everywhere in business. The sales team that knows the playbook but doesn't follow it. The content pipeline that produces wildly different quantity or quality based on who's working that day. AI doesn't just replace the human here. It enforces the consistency the human couldn't maintain alone. Intelligent arbitrage gaps. This is the macro one, and the one that likely matters most for your career. For 30 years, the dominant global gap was labor pricing. Same work, different cost, depending on geography. AI is replacing that with something new. The unit of value is no longer the person hour, it's the outcome. One prompt from the right person can build a working system that scales. The same prompt from the wrong person can build a completely broken one. The companies winning AI right now are the ones with people who can truly leverage these tools. And those people are exceedingly rare. I'm talking about the real people, not the people selling themselves as AI consultants or prompt jockeys who don't understand how AI and machine learning really works. Here's a real-life example of this at play. In the 1980s, when computerized machining arrived, a smart shop owner could buy a CNC lathe, hire an operator at 40% of a master machinist wage, and produce precision parts in 45 minutes that used to take 10 hours. The smart shops hid the machine in the back and kept the machinist up front. They charged the old rate for work done at the new cost. The margin was staggering. Then everyone got CNC machines, prices collapsed 60 to 80%, the premium evaporated. This is the exact arc playing out right now across every knowledge work industry. Agencies, consultancies, and service firms using AI to produce at a fraction of the old cost, while still charging like it's bespoke. That's a window, not a business model, and it's closing. So back to the Polymarket story for a second. Based on that, and the tool being out there, you'd think everyone would be rich. But 94 to 95% of Polymarket wallets are still losing money. They're feeding the successful traders. The tool being available to everyone does not mean the edge is spread evenly. The same is true in business. Everyone has access to Claude now, if they want it. Not everyone has reorganized their workflows, their decision-making, their quality systems around what it makes possible. There's a real and growing difference between bolting AI onto your existing process and rebuilding the process around what AI actually enables. That gap, that's the one that's separating the companies and the individuals succeeding right now from the ones spinning in place. Conventional framing is treating AI disruption as a single event. Meteor hits, disruption, new equilibrium. But that's not what this is. This is a continuous evolution. New capability unlocks a new set of arbitrage gaps. Early movers exploit them. The window compresses, the next model ships, and the whole thing resets. Think about how COVID mutated so quickly that the first vaccine became dramatically less effective in months. That's happening in tech. In 2024, major model releases happened every few months. In 2025, about quarterly. 2026, markets are already repricing within hours of a leaked draft about a model that hasn't even shipped yet. The cycle time between new capability exists and market has priced it in is collapsing. There is no steady state. There's only the next rotation. So what do you do with this information, right? 3 questions, that's it. 1, what inefficiency is your business or career actually built on? Name it. If you can't name it, you won't see it closing. Every business model rests on a gap. Information asymmetry, execution difficulty, aggregation complexity, something, right? Careers too. Product management, to give you one example, right? Product management was built on the fact that engineers didn't want to take meetings and were considered too valuable to be in them. Is that gap reshaping in an age of smaller, leaner teams and async everything? Absolutely. 2, how fast can AI close that gap? Some gaps are structural, they're sticking around. Regulatory moats, relationship-dependent trust, physical world logistics, genuine creative taste, and hard-won domain judgment, right? But most cognitive and informational gaps are closing on a timeline of quarters, not decades. Be honest about which kind of gap you're sitting on. 3, what new gap does the closure create? This is where the opportunity lives, and no one's really looking into this. When AI collapses the cost of producing content, the gap shifts to distribution and taste. When it collapses the cost of code generation, the gap shifts to system design and architecture. When it collapses legal research, the gap shifts to judgment and client trust. The pattern is consistent. The new gap is always upstream of the old one. So it's closer to judgment, it's closer to relationships, closer to systems thinking, further from production and execution. Once you see this pattern, you can trace where value is headed in your own industry before it gets there. So what's the bottom line? What do you get out of this, right? The world has been built on slowly exploited inefficiencies for thousands of years. The slowly part, that's over. What replaces it isn't efficiency, really. It's a faster cycle of inefficiency, creation, and destruction. Turbulent? Yes, but the larger trend lines are readable if you know how to look. The only losing move is to assume where you're standing is a steady state. If you're running an organization, name the arbitrage your business model is built on. Name whether it's structural or not. Name how you're going to take advantage of the new gaps opening up, because there is no other path forward. If you're an individual contributor, understand that the gap between what an AI-augmented professional can produce and what a non-augmented one can produce is enormous right now. Most salaries still reflect pre-AI productivity assumptions. That window is real. Use it and then move upstream, because that window's going to close. Don't be the machinist who smiles at the clients while hiding the CNC machine in the back. Be the person who learns to build the machines. Find the durable gaps, build toward them, and don't let the disruption build you out. If you want help identifying where your gaps are, and more importantly, which gaps are worth building toward, that's exactly what I do. Send me a DM. Let's find your edge before someone else closes it.